Hey, what's up everyone and welcome to episode number 13 of this educational video series. I'm your host VJ and I'm a CPA. Today we're going to take a look at section 179 tax deduction. I consider this particular tax deduction as a true small business tax deduction. In this particular video we'll take a look at an overview of this tax deduction, how it works, and how your small business can take advantage of this particular deduction and save tax liability for the tax year. So with that, let's dive right in. So let's take a look at an overview first. Now if you've been running your small business for a while, you know that whenever you purchase a particular fixed assets, you get to depreciate that asset over its useful life. So for example, let's say you purchased a computer for your for your small business for $1,000. Now computers usually have a 5-year life, meaning you get to depreciate that $1,000 cost of the computer over a 5-year period. Now what section 179 does, it lets you deduct the entire cost of the fixed assets in the year you purchased it. So instead of, in our example, instead of depreciating the computer over 5 years, you would be just able to take the $1,000 deduction in the year that you purchased that particular computer. So it's a nice way to accelerate the expenses and thus get a bigger tax deduction and reduce your tax liability. Now, the reason I consider this a true small business tax deduction is because as per the current regulation, you can only claim section 179 deduction of $25,000 for a tax year that begins after 12/31/2014. So basically any tax year 2015 or after, the deduction that you can claim for section 179 is $25,000. Now this $25,000 deduction is reduced dollar for dollar by any amount of fixed asset purchase that goes over $200,000. So let's say, for example, you purchased a total fixed asset of $100,000, then you could claim section 179 deduction of $25,000 in that tax year. Now if you total fixed asset purchase for a given tax year was $250,000, then you would not be able to claim any section 179 deduction for that year because any amount of fixed asset purchase that goes over $200,000 reduces your allowable deduction of $25,000 by dollar for dollar. So the example that we just took, total purchase of fixed asset was $250,000, which was $50,000 over the $200,000 threshold. So that $50,000 would reduce the allowable $25,000 expense dollar for dollar. That means it would completely wipe out section 179 deduction for that tax year, and then you would be left with regular depreciation for the fixed asset purchase in that particular tax year. Now most small businesses, once they're up and running, and unless they buy a building, the fixed asset purchases are usually less than $200,000 for a given tax year. So they don't have to worry about exceeding the threshold, like the big businesses usually do. So that's the reason why I consider this a particular deduction a true small business tax deduction. Now, one thing I'd like to point out is that this allowable deduction per year amount and the threshold amount is being adjusted by the IRS frequently. So I would highly suggest that you check out IRS website for the limitation for the particular tax year that you're preparing a return for, or just reach out to your accountant or CPA and they'll be able to assist you with that. Now let's take a look at what kind of assets qualify for the section 179 deduction and what kind of assets do not qualify for this deduction. So in order for an asset to qualify for what section 179 tax deduction, it has to be a tangible personal property purchased by the taxpayer, not leased, but purchased by the taxpayer and used in the business at least 50% of the time, and must be purchased from an unrelated party. Now, the assets that do not qualify include any real property, including building, land or building improvements, any leased property, if an asset's used less than 50% of the time in your trade or business, or any investment properties, any intangible assets such as copyrights and patents, and any assets that was purchased from a related party or purchased as part of a tax-free exchange. These all assets would not qualify. So it's pretty clear as to which assets qualify and which assets do not qualify. If you always have any questions, you can feel free to reach out to me. I'll be able to assist you with that, or you can reach out to your accountant or CPA and they will be able to assist you in dealing with the qualification as well if you have questions. So besides the qualifications and the threshold amount, couple things you need to consider before taking Section 179 deduction is that Section 179 deduction cannot reduce your taxable income below zero. So if you have a net, before considering Section 179 deduction, let's say for a tax year you're able to claim full $25,000 Section 179 deduction, but before claiming that deduction your net income, let's say, is $10,000. Now in that tax year you will not be able to claim Section 179 deduction more than $10,000, even though you technically can claim or technically are eligible to claim $25,000 because there's a net income limitation. The remaining $15,000 Section 179 deduction that you were eligible to claim will be carried over to subsequent tax years and will be claimed in those tax years, again subject to the net income limitation. Now, if a business is in a net loss situation, you will not be able to claim any Section 179 deduction. So for that tax year, if you're in net loss, you're better off claiming the regular depreciation and increase your operating loss. Now, if you claim Section 179 deduction on a particular assets and then ended up selling or disposing of that particular asset before the end of that asset's useful life, or the business use percent dips below the 50% requirement, or if you stop using that asset in your trade or business, or if the asset was lost or stolen, then there's a recapture requirement, meaning you had to recapture the deduction that you claimed on Section 179 deduction that you claimed on that particular tax assets, which would increase your net income for a year in which any of these four conditions that we just went over occurs. So that's something to think about. I mean, there is a recapture clause associated with this tax deduction if you stop using that asset in your trade or business. So hope that makes sense, everyone. If you have any questions, as always, feel free to reach out to me. I'll be more than happy to assist you with any question or queries you may have. My contact information is on your screen. Now, a couple things before I sign off today, everyone. As I mentioned in the beginning of this video, I'm a CPA and I own an accounting firm that specializes in working with small businesses and helping them with their tax and accounting needs. If there's anything I can help you with, I'll be more than happy to talk to you. And last thing, if you like this video, please like, share, and subscribe. Will help someone else get this useful information and also help me get the word out about my YouTube channel. So that's it, everyone, for this week. Hope you found this information useful, and I'll catch you all next week. Take care. Bye-bye.